The issue of whether you should be buying property in your personal name or a trust, or for that matter, should be using a company. This question, guys, it's one of those questions that keeps popping up no matter how many videos I make, right? So I'm going to try to give you principles. I'm going to try to give you a framework that could potentially work for you. Now, let's put it this way. There's no one answer here that can apply across. Each person's circumstances matters. And also, your circumstances changes as your life progresses, as your family circumstances changes, as your personal life changes, as your needs and demands and wants changes, so will the results have an impact on how you're going to invest. And this investment could be a property investing, or for that matter, could be investing in life policies, could be investing in provident fund, could be if you got large sums of amount, looking at investing, whether you should be investing through a trust or should you be investing through a company, or for that matter, should you would just leave it as it is in your name and invest. Now, let me give you a scenario. There are things that one typically will have to consider. The main reason on why you're doing that particular investment. If you're going to come and say you're going to invest in property, in that property deal, let's look at deal by deal. And that's how you interpret, and you're going to be able to answer that question. It has to be on a deal by deal. Why are you going into investing in that particular deal? What is the commercial reasons? Are you investing in that deal so that that extra income that is coming as a result of that particular investment is going to sustain you on a monthly basis to live off it? Because you may find that I feel that my salary is not that sufficient to cover my monthly expenses. Therefore, I need that extra 10K, I need that extra 20K from rentals so that it can sustain me. Therefore, can you see that is crucial that, therefore, I take that and I factor it into my decision on whether I'm going to invest using my name or a company or a trust. Then let's pack that. The second thing that one needs to understand, the second principle, is the taxes. Once you have determined that, you say, what are the tax implications for each options that I have? If I were to invest in my personal name, what are my taxes? If I were to invest in a company, what are my taxes? If I were to invest using a trust, what are my taxes? The third thing that we need to understand is who else is going to benefit from that particular investment income. Are you investing so that you can look after yourself? Or are you investing so that you can look after your mother, your grandparents, you've got dependents that are pensioners? Or are you investing so that you can look after your children, minor children? Who else is going to benefit from that particular investment income? That is another consideration. Why am I saying this? I'm saying this because if, for instance, I'm investing so that I can look after my elderly parents, it might be prudent, or it might actually benefit me to actually invest using a trust, because then I'll make them beneficiary and then distribute that net rental income to them and let them be the ones being taxed, which you might find that they are taxed at the lower tax brackets because of them not any other further income in their case. Now, the fourth thing that we need to establish is that particular person who's going to receive that particular investment income, are they also any other form of income except that investment income? It matters because you will know that when a person earns more income, then any additional income will be taxed at the higher tax brackets. As you'll know that an individual in South Africa is taxed on a scaling rate. So that is crucial consideration also that you need to put at the back of your mind. Can you see there's so many things that you need to factor in? That's why each and every deal you need to do this assessment, because the next deal might not be suitable to invest in a trust, or it might not be suitable to invest in a company, or it might not be suitable to invest in your name. That is why it's so important to understand that. Another thing that you also need to factor in is, are you investing in this deal alone or with core partners? Because you also need to be mindful. If, for instance, we invest together, you and I, the challenge could also be that what happens if one passes on? Then it means I must go and pay legal fees, then must remove the ownership from your name, then you must bring it back into my name. It's just unnecessary, too much admin. What happens if there's a delay in winding up of your estate, and then as a result, it takes just quite long? What happens if now I must buy you out and you find that I'm not liquid enough to buy you out as a result of you passing on? Those are some of the considerations that we need to be mindful, okay? So what happens if you default? Then it means, let's say this month is you has to pay the bond repayment, and then you default, then it's going to have an impact on my credit profile. That is another consideration that you need to be mindful of. Can you see that it's so much broad to answer this question? However, that's why once you factor that, then we'll be able to say, in this particular deal, this structure is ideal for you. Then the next deal you come, you say, okay, I'm investing in the next deal for these particular reasons. This is the person who's going to benefit. I'm going into this deal alone, or I'm going into this deal with Tsapo. Therefore, how do we structure it? Then we say, okay, I think at this stage, let's look at it this way. Also, we need to factor in taxes at death. We know that the more you build wealth in your personal name, upon your death, there are complications when it comes to what you call deathbed expense. Deathbed expenses are potential capital gain tax that you need to pay, estate duty that potentially you might have to pay, executors' fees, income tax, taxes that you need to be paying, conveyancers and transferring attorneys' fees, bond cancellation fees. So those are some of the costs that most of us don't really pay attention, or we actually tend to ignore when we're investing. We forget that the more we build wealth in our personal name, the more. There are solutions. You may find that trust is a solution. Other people, then they consider things that we call insurance covers, that it brings in liquidity into the investment, because some people want sense of ownership. Therefore, they still feels like they still needs to have assets in their names. Therefore, but then they consider things that brings in liquidity into their estate. Then that liquidity is able to settle those deathbed expenses that I just mentioned. Right? So those are some of the solutions that you can also implement. Hence, I'm saying, guys, in order to answer this question, it's important that you look for deal by deal basis and you analyze that using the framework that I discussed earlier. Okay, if you still don't have a clarity on this, you're more than welcome to book a complimentary estate consultation with me. Use the link on my profile, on my TikTok profile, and then book 15 minutes to clarify based on your scenario, and then you're good to go. Okay, all the best.